Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Long Verticals and Diagonals. And today I wanted to talk about a trader who wants to just pop in and out with a nimble little trade, a bearish trade in a bullish market when we think that markets might be looking a little bit overbought in the short term. Could there be opportunities? We'll be talking about the pros and cons of that. We're going to be placing an example trade today in an effort to do just that. Before we can get into any of that discussion, I want to first of all say hello to everybody who's chatting in out there in YouTube. Hello there, everybody. John, Miralai, Kevin, Andrew, Richard, Greg, Naresh, William, Josh, everybody else. Thanks for joining us week after week. We always do appreciate your attendance and your contributions to these discussions. If you happen to be here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the fact, well, enjoy the recording, but be aware that you're invited to join us in the live discussion. This is a Thursday webcast series. If you'd like to be here, we kick things off promptly at 11 Eastern time. We'd love to have you here in the live audience. And as a nice treat for my live audience members, my very good friend, Scott Thompson, is going to be hanging out in the chats, addressing any questions that I can't get to. Scott and I go way, way, way back. Scott brings a ton of experience to this, so he's a great resource to have. Thanks for having my back there, Scott. And I'd also like to issue an invitation to everybody watching. If you have an account on X, you should be following your favorite Schwab presenters there on X. You can find me there on X at Cameron May CS. It's the best place to connect with me in between the live streams. If you reply to one of my posts, I just try to reply right back to you. That gives us the ability to communicate when the camera is not on. So that's great resource for you there. But let's get into this. And as we do, of course, there are risks associated with what we're discussing. So bear these important disclosures in mind. Options carry a high level of risk and are not suitable for all investors. The information here is for general informational purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Schwab does not recommend the use of technical analysis as a sole means of investment research, and investing involves risks, including the loss of principal. Okay, so what are we going to be doing with our time together today? Well, this webcast or this video is part of an ongoing series. So the first thing that we're going to do is take a look at our 4 current positions in our paper money portfolio, see if there's anything that needs to be done with those. I think there's some interesting things happening there. We have some important decisions to make. So let's talk about the trade management. Then we're going to take a look at the S&P 500 and use that to set the stage for why some traders, even when markets are very bullish, they may look for little windows of opportunity for what I might call a little nimble trade to get into and out of a bearish position, maybe introducing a little bit of balance to an otherwise very bullish portfolio, just in an effort to snag a little bit of opportunity out of a bearish pullback. So we're going to be talking about the potential advantages and, of course, the potential risks of doing that. And we'll be building and placing an example long put vertical spread to illustrate those concepts. And we'll wrap it up by placing that trade with a plan for managing profits or losses. So let's go right to it. Let's go have a look at our current portfolio. And right now we have 4 positions, and overall they're doing just fine. We have GILD, which is a long call diagonal spread, bought a 17th of June 2027 $95 call. We paid about 16 bucks. That's worth about $26. So we're up on the order of $10.5 per share on those 300 shares in those 300 contracts, or those 3 contracts. And currently we're in a 120 short call for the 17th of October. So that expiration is approaching, but this is a fairly new short position. Sold that for 142. It's worth about half that. So that's also profitable. Let's go see how that fits into the longer term story of this diagonal spread on Gilead. So here's the $95 call. We purchased it way back at the end of January, and stock's up from where we purchased that. So that accounts for why that thing is doing so well. But along the way, we've sold short options, shorter term short options against that longer term long call contract and created diagonal spreads. Now, a couple of those, we took some losses. The bulk of them, we've taken some gains. So we find ourselves now in that long call, hoping for prices to go up, not having a good day today, but this is treating our short call well. really our preference here would be for our stock to go up as we're approaching that 17th of October expiration, but to stay below 120. All right. This one, I'm going to let it continue to work. I do want to have a look at what's going on with Google, though. Google, we cut in half last week. We took some profits on this one. So let's see what's been happening. So this is another long call diagonal spread. Bought 2 contracts of the 180 long calls back here. Bought those. We actually closed out one for a very large profit relative to what we paid for those contracts. Made $50 on the exit there per share. That's a nice $5,000 realized gain on the long. Now the shorts, though, have not been quite as kind to us. We did take a small profit on a couple of short calls here, but we rolled up to the 215 short calls and the stock just took off and blasted straight through those. So last week we made a tough decision. Actually, previously we'd done this. We closed out one of those shorts for a 32.80 loss. Ooh, what does that do to this $50 gain? It's taken a big chunk out of that. Now we closed out the other one for an additional 32.60 loss. This is starting to turn into a horror story. Don't get too excited about that. It's actually still quite a profitable trade overall. It's just an unrealized profit on our remaining long call. So we have a gain of $50 here against a loss of about 33. Here we have a realized loss of about 32.5 against an unrealized gain on our one remaining long call contract. I think that's up about $40 right now. So still doing just fine. Overall, it's quite a profitable trade. Yeah, you'll see we bought that other long call for about $25. And it's worth close to 70. So if you'll forgive me, I'm going to do some very rough math, up about 45-ish dollars per share. Is that right? Yeah, about $45 per share. So taking the haircut of 32.5 on the short might not feel quite so bad when we say, well, at least we're up well more than that on the remaining long call. Now, at the same time, though, let me drag down our y-axis a little bit. We closed this one out at a loss, but then rolled up to a 265 short call. So this one's still solidly out of the money. The preference now being for our stock to resume its upward trend, helping out that long call, let it continue to build in value. We'd like to see the current short call expire worthless. Okay, so let's see. That short call, it's worth about half what we sold it for last week. So that's taken a little bit of the sting out of the other short call that we've closed. Unrealized. These are unrealized gains, but both of the current positions are doing well. Here's what a trader might consider, though. This is what we talked about last week. With the stock having run up so far, could it fall back further? Or could? If it did, this short call, that'd be nice. About another $1.50 that might be made there. But the long call has a ton of value, $69 at risk at this point. A lot of that is profit. If we were to fall far enough, we could start to encounter losses. So a trader might really consider, does this appear to be just a little bit of a short-term pullback, or does it look like a trend reversal? Let's say that our trader here throws on a Fibonacci, and they notice, since this gap up, this is kind of interesting. We gapped up, a lot of enthusiasm right here, driving the price higher, raced up after that gap, and as we pulled back, it's interesting to a Fibonacci trader maybe, that we've come down to about a 50% retracement, almost exactly. So for some traders, it's kind of normal technical behavior. It may signal that we've already hit our short-term lows and we're likely to go higher. Time will tell. I'm going to leave that one to work. Remove that drawing. Let's have a look at our remaining 2 positions. We have NVIDIA. This is just a long call vertical, the 160, 165. We'd like to be above 165. Right now we're at 177. Mary Burns says, are you looking at relative strength for any of the decision to exit? There are so many ways a technician could approach management of exits on charts, right? There are literally hundreds of technical indicators. So am I looking at relative strength in this example? No, I'm not. Does that mean that no technical trader could be justified in looking at relative strength? Nope. I'm just saying there are lots of different ways to it. It's kind of like when we want to get in shape. You can get on a treadmill, you can get on a stair climber, you can get on an elliptical. They all do very similar things. Slightly different benefits from one to the next. Slightly different shortcomings from one machine to the next. Very similar with technical analysis. So good question, but not looking at that for this one. Not to at all disparage that as a technical approach, though. All right. So NVIDIA, let's just take a quick look at it. It's actually doing well. It's a recent trade. Took this one a couple of weeks ago. Bought the 160, sold the 165. These expire in on the 17th of October, and we prefer to still be above 165 as we get toward that. And you can see it's working its way there. It's pretty close. If you look at, we got in right around the opening of this day, and if you look at where we are right now, we've been down, we've been up, mostly sideways, which for this in the money long call diagonal spread is just fine. Okay, now let's see. As a matter of fact, let's see how close we're getting. This is a $5 wide spread. When we own a $5 wide spread, the preference for that trader is to see that get to as close to $5 in value as possible. So one quick thing that a trader might do is look over here at the mark or the current market value and see if the difference there is already close to $5. You can see it's actually about $4.25 difference. We're getting there. We're in 9 contracts. What might the trader decide to do at this point? We're up actually about 90 bucks. So we're close to $5. The problem is we paid close to $5. So really, this is kind of a slightly above break-even trade. I'm going to let that one continue to work. And you can understand why it's slightly above break-even, because net, the stock has actually gone just marginally downward, but the time that has passed, we're closer, we're at least closer to expiration while still in a position for potentially make our maximum gain. So that's worked a little bit in our favor. Now, finally, we have UNH. Let me see, Beauty at Sebest just asked a question. When markets pull back, is it best to sell options because the expectation of stocks continue to decline and sellers keep the premium? Well, Beauty at the Best, it depends, right? If the markets pull back, selling options, if we sell a put, sell a call, that's one potentially bearish approach. But if they pull back a lot, maybe we should have bought a put. Selling a call is bearish with limited upside, but a higher probability depending on how the trade's structured. Buying a put, lower probability trade, but larger reward potential. So when we use the word best, you will never hear me say, by the way, I almost never use the words never or always, but I never say that something is the best approach because it depends on the trader's, it depends on whether it's suitable for that trader's portfolio, for where they think the markets are headed, lots of different variables. So you're asking a very legitimate question that I just can't give an absolute answer to. Okay, United Health Group. So in this one, we own a 2027 long call. And these ones, if you click on the quantity, you can see this trade was just entered a week ago. Today is September 25th. We entered this on September 18th. So this is last week's trade. Bought a $300 call, sold the 360 call. The preference here, well, that 300 expires in a couple of years. This 360 call expires in a few weeks. So the preference here is for the stock to go up, but to stay below 360. Right now we're at 346. Here's what that looks like on a chart. Another diagonal spread. Last week we spotted what appeared to be an inverted head and shoulders with the head being represented by what's known as an island gap reversal. Gap down followed by a gap up. Pretty strong apparent reversal in investor sentiment. And we've just broken up through the neckline. And we thought that may act as a short-term support level, and it looks like it has. Here's where we were discussing things last week, and we're coming up from that. Got close to our short call, but just pulling back away from that, that's almost ideal. That's really what we'd like to see here. As we move toward that expiration, the real preference is to be below 360, but as close to 360 as possible. So our trade's currently doing fine. That Google one, this is going to be an interesting one to follow. See if it continues to fall back from those really high peaks that it has reached. But that brings us up to speed on our current position. So let's go have a look at what's going on with the markets and see why a trader might look to possibly do some bearish short-term trades, even if they're overall bullish. Now, the markets have come up very sharply off these April lows. This is an extremely bullish market condition. 39% off those lows is like 4 years of market productivity in about 6 months. That's how bullish this is. But even within that, the market and individual stocks don't tend to just go straight up, but they'll tend to move up and then pull back a bit, and move up and pull back a bit. So a trader might be forgiven for being very bullish, but does anybody ever feel like, oh, this can't go on forever? I'd sure like to have at least something out there that's a little bit bearish, just in case we get that turn. Well, under those conditions, that the trader might look for these quick bursts up that are followed by a bit of a pullback. So for some traders, they try to do a little quick, what I would call nimble trades, little bearish trades. Now there's a difficulty here. These windows are very short term on average, especially if you look at the way the markets have been since April. At best of times for the bears, maybe they get a couple of days going down. So trying to be that precise, taking advantage of price moves, it can be really difficult. Now, that doesn't mean that there's not a bearish potential opportunity here. Instead, what traders might do is, instead of looking for trying to capture a downward move, maybe they're just trying to capture a period of time where net markets don't advance. That sounds like the same thing. It's not the same thing. Going down is one thing. Not going up is another thing. So, for example, during this period, well, I don't want to draw into the fib. Let me remove this. Let's say the market's raced up and we start pulling back a bit. Well, for about a week, the markets didn't go down very much, but they didn't go up above previous highs either. Here we hit a peak, didn't go down a lot in the grand scheme of things, but also spent about 2 weeks below highs. You can see that happening relatively over and over again, even in this very bullish market. So those little windows may be what a trader is targeting with these conceptually little quick little moves. So first of all, how might we identify a window? Well, lots of different ways that a trader might do it. Let me just talk in some familiar terminology to those who watch our webcasts fairly frequently. A lot of you probably heard one or two of our coaches mention something known as a close below the low of the high day. Just means when markets or stocks have gone up, we look for the highest day and then look for a subsequent day to close below that high day's low. Oh, that sounds like a mouthful. Here's what I'm talking about. Let me zoom in. Just yesterday, we hit a new all-time high on the S&P. Here was the low of yesterday. And you'll note, not yesterday, sorry. Nope. I got to roll it back one more day. So today is Thursday. On Tuesday, we hit an all-time high. And yesterday, we closed below the low of that all-time high. Below the low of that high candle. And for some, that may be signaling a potential pause point where we might have one of these times where stocks just don't really advance much. That's not a very good line I drew there. It's kind of upward sloping. Anyway, but there may be a week or so for the implementation of the strategy that I'm going to be discussing. It may not work out. That's definitely a possibility. But this is what we know. This is what we call a close below the low of the high day. And that may be a signal that a trader looks for to initiate a strategy like this. Now, this is not going to be a strategy that requires stocks to continue to fall. Instead, actually falling is great. It is a bearish strategy, but even if the stocks continue to go sideways for a week, this strategy may work out. So we're going to be doing a short-term bear put spread that benefits if a stock is just able to stay below where it is right now for a week, right? And we're even going to set up plans to try to get out before that. So the emphasis for this trader is going to be nimble, 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 quick, quick, quick. So let me set up an example trade, and I need your help. First thing that we're going to be looking for here, if the trader sees what they think is a window of opportunity on the markets, maybe they look for something similar on a stock that they think is more likely to go down for a week, or at least just not go up for a week. So I'm going to look at 3 stocks selected for a very specific reason. When we're trading, we're going to be trading very short-term options, sticking with these contracts, sticking with contracts that expire at the latest next Friday. So about a week at a maximum. The contracts we're going to be looking at are going to be 8 days. So when a trader is trading very short-term contracts, those are known as weekly contracts, there can be lots of liquidity issues with those. There are hundreds of stocks that offer weekly contracts. It's quite common nowadays. It used to be just a few, now it's a whole bunch of stocks, but the liquidity is not great on a lot of those. And a trader will see that when they look at that spread between the bid price and the ask price. Here's an example. Let me bring up, this is a big company. Eli Lilly is one of the biggest companies in the world, and you can see it's been coming down. Maybe the trader sees that it's bumped its head against a trend line, and it's actually accelerating downward as we speak. And so the trader might think, oh, let me set up one of these trades that Cameron's talking about. I'm going to go to the trade tab. Let's go to the 8-day contracts, and I want to look at, let's look at some maybe, well, it doesn't matter which ones. We'll just look at the contracts in general. How about this 720 put? One of the biggest companies in the world, one of the most liquid companies in the world. Look at the difference between the bid price and the ask price. There's more than $1 on a $13 contract. That is a very wide spread. That spread represents friction in the ability to trade these contracts profitably. What that can do, now, if the contract is long enough in term, maybe the trader has some time, if things go well, to make up for that frictional loss on that bid-ask spread. That's kind of a sluggish start. Guess what a trader probably doesn't want when they're trying to be nimble? They're trying to be quick. They're trying to be like Jack, I guess. Anyway, we don't want that sluggish, wide bid-ask spread start. So there are only going to be maybe a dozen stocks out there, a couple dozen stocks. The trader probably wants to be very selective, watching that bid-ask spread. So let's look at a few stocks that have narrower spreads, more liquidity even than a company like a giant like Eli Lilly. Let's go to our charts. And I'm going to look at 3. And remember, so the trader here is looking for bearishness. I want you to chat in, let me know which one do you think might be most bearish. Let's start with Apple. Speaking of the biggest companies in the world, here's what's been going on with Apple. It's super bullish, right? Except if you look at where it was, look at where Apple was just, how long ago was that? Two weeks ago? Yeah. 225. It's raced up to 255, a $30 move, that's about 15%-ish in just 2 weeks. And interestingly, where has that positioned Apple relative to previous highs? Maybe right at a resistance level. Okay, there's candidate number 1, and for some traders, this is going to go directly against their grain. Are you talking about setting up a bearish trade on a stock that's been incredibly bullish? It's sort of the theme for today. Yeah. So there's Apple. Keep that one in mind. What about Tesla? Another huge company. Another one that has rallied sharply up to previous highs. Maybe the trader thinks it could pull back. Do we need an enormous pullback? Nope. Just a pause. for a week. That happens, the trader might do quite well with this strategy. If it doesn't happen, they could take some lumps. So there's Apple, there's Tesla. Now, one more. Maybe this looks a little bit better to some technicians out there who prefer to see a trend really, this is actually recovering from where I saw it this morning. But in any case, we had a strong gap up, hit a peak here, and started to pull back. You can imagine with this long tail on this was a big red candle earlier today. Looks like we're starting to see some strength. But we have penetrated into that gap. Some traders, when they see a stock drop into a gap, they start to assume that gap is likely to fill. I'm going to leave that on there. That's our third candidate. So we need to pick one. Which one do you think? Apple, maybe it's helpful. Just think, you don't even if you haven't processed which strategy we're going to be doing, which strategy might we set up a bearish trade on? Apple, Tesla, or Broadcom? Got one vote in for a Tesla. Right? Well, this is good. Tesla, Apple, Broadcom. The rest says go back to Eli Lilly. Tesla. Oh, looks like Tesla just got it. Okay. So I'm looking for 3 votes. So we had Andrew with Tesla, Ron with Tesla, Kevin with Tesla. Let's go to Tesla. That's going to be our example trade today. So here's what the trader is going to attempt to do. We're going to try to set up a trade that can benefit from either a short-term pullback. That's great. That would benefit this trade even more, or just staying below recent highs. I wonder. Let's look at this. Looks like our highs are around 440. Let's go to our trade tab. Let's look at the 440 strike on the puts. Might need a few more strikes here. Let's crank this out to 20 that are being shown. And look at that. Okay, so we're talking about, we may not be able to pull it up, push it up quite that high. We're going to see. But that 440 strike is pretty deep in the money and yet only has about 15 or 20 cents difference between the bid price and the ask price. Can you see how that is a much tighter spread between the bid price and the ask price than on Eli Lilly? Lots more liquidity here. So let's maybe consider, let's see what we could do this for. What if we were to buy a 445 and sell a 440? Looks like maybe there's about a $3.5 difference between those two. Okay. All right. So here's what we're considering doing. Let me go to the chart and spell this out for us. These contracts expire on the 3rd. So I'm going to draw in a line on the 3rd just so we can have a visual reference point for that. That's right here. Okay. There's expiration. You can see where we are right now. We're trying to get to that expiration. We're considering selling or buying a 445 put. That's right up here. I'm going to draw that in as closely as I can. Right there is 445. And then right below that is going to be our 440. That's going to be our put vertical spread. And where we would like for Tesla to be on the 3rd is below that spread. So I'm going to draw in a box here. Let's make this, that's our green box. This is where we'd like Tesla to be. That's where it is right now. We've pulled up sharply. Maybe we're getting ready to sell off a little bit here. We'll see. Where we do not want to be is up here. Let's change that. Let's make that a nice light red. There we go. There's our hopefully no-fly zone. So this is the trade that the trader is setting up. And you can see we really don't have much time to cover here. The stock is already where it needs to be. Time should be working in the favor of this trade as long as the stock doesn't start to rally too much. Now, even with this very short-term trade, the trader may even be prepared to be even shorter term. If we're trying to do a quick trade, how quickly can the markets turn and continue to rise with the markets being as bullish as they are? How quickly could Tesla decide that's enough of a pause, we're going back up? Could happen really quickly. So let's set up our trade. Let's figure out how much we can make. And in this case, the trader may be willing to just settle for half of that. So let's go to our 440, 445 bear put spread. And maybe I'll set it up this way. Let's go to where it says single. I'm going to change that to, let me use this technique. Let's come down to deep and wide and go to 1 month, 2 strike vertical. How many of you have used that before? This is probably going to be new for some people. Deep and wide, what this is referring to, we're telling the system, hey, we're about to do a vertical spread where both of our contracts are in the same month. So it's 1 month that we're dealing with, but they are 2 strikes apart. So here's what that means. The 445 is 2 strike increments away from the 440. We got the 442.5 in the middle. We don't need to deal with that one. So yeah, let's go deep and wide, 1 month, 2 strike vertical. So that's going to pair up the 440 with the 445. And it lets us take a quick look to see how much would this thing cost. Well, probably somewhere between 325, maybe 335 and 370, right about 350-ish. Let's click on that. Let's create a buy order. Let's position size this. Now, this is another consideration when a trader is trading against what they see as the prevailing market trend. Might that trader think, and how about we lock that in for a second? Let's say we're willing to spend 365. That's okay. I'm gonna lock that in there. But if a trader suspects that this may be let's say, a higher risk than normal trade, maybe it's under market conditions that might not be optimal. This is a time when maybe the trader scales down their typical position size. So normally in this webcast series, very commonly we'll place trades and risk about $4,000. How about, just to illustrate that concept, let's risk $2,000, right? So if we're spending $355, one contract is $355. That's how much we can theoretically lose. 3 contracts would be $1,000-ish. Let's do 6 contracts. There we go. So we have downsized the position to accommodate for the fact that, yep, we're trading a bearish trade in a bullish market. But we're gonna further. Oh, look at this. This just moved on us a little bit. Maybe we can get this at a lower price. I'm gonna leave it in there. Should we try for 350? No, I'm gonna stick with 355. Okay. But let's talk about trade management. We're about to spend, hopefully, $355 for a $5 wide spread. Do the math on this. We'll have the right. We have the right to. Well, someone has the right to sell shares to us for $440. We have the right to sell those same shares to someone else for $445. So if these are exercised and assigned, that's a $5 value that we paid $355 to set up. So that leaves $1.45 in profit. So that kind of spells out for us how much we can make and how much we can lose. We can lose $355. We can make $1.45. If it's helpful, we can spell that out on a scratch pad. I got a request. Most of the time I spell these out on a scratch pad. Other times I don't. And somebody said, hey, I really like it when you do, so I'm going to do it. Mighty Mouse says, how do you decide the strike? So Mighty Mouse, with this, good question, we went above recent highs, right about there. So that's about where those highs were, about 340, about 440. With these short-term trades, going much higher than that, yeah, it'll increase the probability of success on the trade, but the reward potential will diminish rapidly. So those trades become more expensive with a higher risk and a lower reward because of the high probability. So, yep, so I was using that recent resistance level, okay? But going back to our trade, it's an example trade. It's a long put spread. We are the net debit here. Also, the theoretical maximum loss is 355. That leaves us a theoretical maximum gain, $5 minus our investment. There we go. Salient Joe says time decay is a major factor in this sample trade. It exactly certainly is, Salient Joe. Well, is that a positive or a negative thing with this? We're buying a vertical spread. Oh no, we must have negative time decay because we're buying options. Nope. This contract is in the money, which is where we want it to be. So every day that we get closer to expiration, while it's still in the money, hopefully the same distance in the money, time decay is theoretically working in the favor of this trade. Yeah. So it does play a role, but interestingly enough, when I said earlier in this session, we're not trying to take advantage of a big price move. We're instead trying to take advantage of a period of time where the stock doesn't go up, right? Anyway, this is our maximum loss, theoretically. There's our maximum gain. So for some traders, it'd be nice if we sit out the whole week, maybe we make the 145. But maybe in the spirit of just being as quick in and out, maybe the trader decides, let's just take half of that. So I'm going to put it in order to get out with 50% of that maximum gain. At the same time, I'm going to put it in order to manage the downside of this. We could lose 355. That could happen very quickly. In this case, we're going to put in a stop to get us out with just 25%. This is going to be a pretty tight stop. We're not going to put up with a lot of shenanigans from the stock. When we put in a tight stop, that really increases the likelihood that the stop is triggered. There's a trade-off there. Trying to minimize risk tends to maximize the likelihood of actually incurring some amount of risk. I know that sounds counterintuitive, but it's accurate. Anyway, so let's put these into practice. How is this accomplished on the trade? Well, 145 is the most we could make. So if we want half of that, how much would we have to sell this 355 investment for to make half of 145? 145 is kind of an awkward number. Half of that is 72.5 cents. Let's round that up to 75 cents. Let's say we want to make at least 75 cents. Well, if we buy for 355 and then we sell, let's do the math on this. Buy for 355. And if we sell for a 75-cent profit, that would be $4.30. Okay. So let's put that in. Let's come down here where it says advanced order. Right now, it just has a single order ready to go. Let's change that to first triggers an OCO order. This allows us to put in two sell orders. One to manage profits, the other one to manage losses. Let's right click here. I'm going to create an opposite order. This one's to take our profits at 430 if we can get there. I'll make that good till canceled. So if we're able to get in for 355 and then sell for at 430, that would be a 75-cent gain, which would be half as much as we could ultimately make if we leave this alone, let it get to expiration, if it works out. All right. Well, what about taking our losses? Well, if we spend 355 and it drops by a quarter, let's multiply this by 0.75. That's 25% lower. That means we have a stop in at 266. I'm going to round that to 265. Okay. So let's put in a stop at 265. Right click, create another opposite order. And this is going to be our stop at 265. So this really is designed to be a very quick trade. Trying to buy for 355, and either time might be able to get us to a 430 exit, making 75 cents. Or if price moves down, that could also get us there. Now, if we start to move in the opposite direction, we're going to have a stop in place to mitigate that risk. So in at 355, out at 265 means that we have about a 90-cent risk potential on this trade. So let's click confirm and send. buying 6 of these, 445, 440 puts for 355, selling them either at 430 or at 265. Now, there's a possibility here. Is it possible that the stock does just the right thing to stay between those two extremes? Yep. So the trader might want to pay close attention because it is possible that neither one of these gets tripped. We need to keep an eye on it till expiration. But let's remind ourselves, due to potentially wide markets or liquidity risks at the time of the activation of the stop, is what this is referring to, that order may be manually substituted with a limit order upon activation and worked until it's filled to get those 6 contracts filled. It also has a reminder here that we've selected a weekly option series. That was intentional. The 8-day contracts with a non-standard expiration. These are not like the traditional third Friday expiration. Now, there are commissions to be paid here to get into and to get out of this trade. Okay, Jerry says, Jerry, okay, good question. What are the advantages and disadvantages of stop limit instead of just a stop? Okay, Jerry, for some people, for some traders, they have a stop and they're afraid of a gap. And they try to mitigate that gap risk. So, for example, maybe I'm willing to sell at 265, but if the stock moves really fast, and now I'm only able to get out for $1, maybe I prefer to hold on and see if it recovers. There's the risk. The limit keeps us from stopping out initially at, let's say, too low of a price, but it could keep getting worse. So there are pros and cons to that. Harry says, where can I find a discussion of short versus long spreads? Good question, Harry. I'm gonna show you that in just a moment. John says, I was doing stops and profits with order rules. I'll try out these advanced orders. Okay, well, I hope this is helpful for you, John. Just, always the trader might want to experiment with paper money first to get acquainted with any new approach and then ultimately decide this is not a sales pitch to do it this way. This is just an example of this. Andrew says, how did you calculate the 90-cent risk again? 90 cents is 25% of our initial cost. That's it. So a 25% stop is another way you might think about this. So let's send this order off and we'll see if we can fill. There it is. Okay, bought at 340. Okay. All right, well, from here, we'll see. See if we take a profit or a loss, but there is an example of a quick trade, bearish trade, in a bullish market. Hope you enjoyed that. We'll follow up on this in next week's webcast, but I have some suggestions for you between now and then to help to make sure that you're taking advantage of all of the educational offerings from Schwab. Number one is to make sure that you have followed us on X. Pardon me. Now, let me pause that. Make sure that you have subscribed to our YouTube channel. All right. Our Trader Talk Schwab Coaching webcast YouTube channel is where we house all of our previous webcasts. Like you can go back and watch last week's webcast, or in the future, you can follow up on this one. Go back and revisit it. You can also join the live streams here, and you can do searches, for example, to go to who was asking the question. Harry says, how can I find a discussion of long versus short spreads? Look at this, Harry. Long versus short spreads, also known as credit or debit spreads. I'm going to type in credit, debit. Look at this. Options vertical showdown. Trade a credit or a debit spread. There you go. You might want to check that one out. Now, to go back to my mention of X, you should also be following your favorite presenters on X. It's the best place to connect with us in between these live streams. You can find me on X at Cameron May CS. This is where I can have interactions with my followers, with those who like to watch me on the videos, or just like to interact with me. I can post things about the markets, ask questions, we can learn together, and if you reply to one of my posts, I try to reply right back to you. I reply to a very, very high percentage every once in a while. I can't ever say perfect at anything, but this is the best place to connect with me in between these streams when the camera's not on. Now, I also want to thank everybody who has clicked the thumbs up button 166 people watching, 56 have already clicked that like button. That's very much appreciated. It's like a pat on the back to your presenter, and it gives my video a nice boost in the YouTube algorithm and helps me more people find these sorts of discussions like trading quick bearish trades in bullish market conditions. Now, final point I want to make is that there is a survey out there in the chats. So if you're in the live stream, click on that survey link right now that Scott has kindly reposted and give me some honest feedback. What I'll say is it's a very short survey, just 2 multiple choice questions, a comments box and a suggestion box. And if you take the time to fill that out, I take the time to read through all that stuff. It goes right to me. I read through the data, I read through the comments, and it helps. All right. So thank you, everybody. I will see you next Thursday. You're also invited to join me in my other regularly scheduled webcasts, something new every day of the week. So I'll look for you there. I'll also look for you on X, but whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.